So how can I see you guys? So everybody make their camera off?
Yes, most
Yes.
like to make
Most
the
of.
camera off and also the
Okay.
microphone off.
Okay. Perfect. So are you ready? You guys are you ready? Yes? Okay,
Professor.
perfect. You can shut on that. Perfect. Okay. So
Okay.
thank you for first of all, good evening to everybody. So my name is Pramon Bunkanwanisha. I'm professor of finance at ESCP Business School in Paris. I'm originally from Thailand, so I have been teaching in this program for more than 10 years now, I guess. Very, very happy to be with you. I hope that we're gonna have a good time together for these interesting courses of financial structure and strategies. Okay, so please feel free to, uh, you know, ask me question on the chat, and if you need to ask me talking, I just raise your hand and then we can discuss. So I would love that we have the how we call interactive session, which is not easy when we do it online. So I miss Vietnam a lot. But hopefully that I can see you guys in the future, in probably in more advanced courses. Okay, today, okay, or the program that we are going to do is we call the financial structure and strategy. Let me show you the how we call that one, the syllabus, the program, so that you can see here. Everybody can see this one? Yeah, you can see it? Oops.
Yep, yep.
Yes, okay. So the financial structure and strategy actually is the kind of second fundamental courses of corporate finance. You have been studying the investment decisions, and then which is more on the left-hand side, where the company or the corporation need to make a good decision to invest. Okay, invest on the left-hand side. Once the project or the investment is good, we're gonna talking about the right-hand side, where we can see how we're gonna finance those left-hand side, the project, the good project of the left-hand side. So how we define a good project to invest? So we're gonna invest any project. If I'm a corporation, I have an investment. You have studied with Professor Olivier Cozard, if I'm not wrong. So when you make a decision on the left-hand side of balance sheet, everybody know what is a balance sheet. You have just learned about financial statement analysis, right? So the balance sheet is the left-hand side and the right-hand side. Okay, the balance sheet is a kind of the if you take, your cell phone, you make a kind of selfie on your corporation, you're going to see that the left hand side, which is called the assets. Assets means that what the company own, okay, to or own. And then on the right hand side show how the company finance those assets. Okay, you have only two ways to finance those assets. Either you borrow from someone, you issue debt, or you raise capital from the equity holder, okay, who provide capital to the firm, Okay, and then when you provide capital to the firm in the form of equity, you becomes a equity holder. You have the right to receive what we call the dividend. You have also the right to vote to control a corporation. Okay, so where if you provide financing through debt, okay, it means that you lend the money, the company borrow from you as an investor. If you don't go to the traditional banks, okay, you can go to the capital market. What's the name of the capital market where you can borrow or corporation can borrow the money from the capital market? What kind of debt the corporation can do to borrow the money from the corporation to finance a project? Anyone can answer on the chat. How we gonna raise funding through the capital market by borrowing from investors? How are we gonna do that? Anyone? Please, I have seen several people try to type it. You issue bonds. What is a bond? Bond is a debt instrument. Okay, it's like when you go to the bank, you get the bank loan, you sign a contract with the banks, the bank lend you the money, and then you and the bank agree upon the payment schedule. Part of them you're gonna pay the interest to the bank, and part of them you're gonna pay the principal back to the bank at maturity, or is amortize your loan, and so on and so forth. You have several ways to arrange your debt financing through the bank loans. But these days, especially in the capital markets, in the advanced corporate capital markets, they not necessarily go to the commercial banks. Okay, why you don't want to go to commercial bank when you are in advanced country? You can go directly to the investor and get the money or borrow the money directly from the capital market, and the capital market that allow you to borrow we call the bond market. When the corporation want to borrow $1 million, they can issue a bond with equivalent value of $1 million. That makes sense? Okay, so when you are issuing bonds, when the investor, okay, who lend you the money, okay, in by buying the company bond, okay, when you buy a bond, you become a bond holder. You expect to get what? What do you expect? If you are an investor, you buy a bond issued by Amazon. Okay, you buy Amazon bond. What do you expect? You become a bond holder of Amazon. You become a bond holder of Amazon. It means you are the lender of Amazon. You expect to get the interest, but in particular, in finance, we need to be very precise, and the term that we use in the capital market is very precise. So Mantong do said you expect to get coupons. Okay, if you have a kind of regular coupons, okay, like you buy the coupon bonds, okay, you can have several coupons that they can pay every 6 months, every 1 year, and so on and so forth. You have studied already how to value the bonds, right? So, and then what do you expect after coupons? You expect to get your principal or the face value when you can expect to receive it at maturity. Okay, you can buy bond with 1 month or 3 months or 6 months and 1 year, 2 year, 10 year, 20 years, and so on and so forth. You can choose different type of maturity. The maturity determine or tells you when you're gonna get your principal back. Okay, so When you buy a bond, you become a bond holder. You expect to get two things. One is your coupons at and then your face value at the maturities. That is the way you can borrow the money. If you don't borrow the money, okay, you want to go to the capital market and then invite investor to own the company, okay, by buying a share. You issue, for example, common shares, and when the investor who buy common share, they become a common shares holder. What do they expect? When you are common shareholders, okay, you are the stockholder, you expect to get dividend. Okay, do you expect interest? No, we don't have expect. You don't know how much dividend you're gonna receive. Okay, you expect to get dividend, but once, if you are not, how, when you're gonna get your money back on your investment? No, as long as you keep your shares, you expect to get to receive dividend forever. Okay, up on the time where you're gonna sell your share. If the price that you sell is higher than the price that you bought, you're gonna get something called the capital gain. So when you buy a stock or share, you become a shareholder or the stockholder, you get two things as well. One we call dividend, second one we call the capital gain. That is what we call the cash flow rights. But when you buy a share, they have also another rights that they give to the common shareholder, which is called the voting voting rights. In general, in most of the common share, we use the principle of one share, one vote. If you buy one share of Amazon, you're gonna have one voting right on Amazon. If you have the total outstanding of Amazon, of I don't know how millions of shares of common share of Amazon, you're gonna know what is your proportion of voting rights. And the voting rights that give you an interesting characteristics, unlike the bondholder don't get any the voting rights, okay, but the common shareholder, you have the you have the voting right. You have the voting right to do what? You're gonna vote to, what is the voting right is for in the corporation? You have a voting right to vote. To vote what? Very first mission for a corporation is to vote, to choose, to participate in the decision making process. Okay, what is the decision making process that the company need to do? One of the very common and important process or decision you have to do is to choose to choose the manager or the CEO to run company on behalf of the shareholders. Okay, how the company organized. So when you have millions of or thousand or 10,000, 100,000 of the shareholders or investor who own shares, so usually those shareholder will gonna choose or select, okay, or choose what we call the director to sit on the board of directors. So you have the president and the board of director. Board of director, we're gonna make decisions together on behalf of the shareholders. Okay, and one of very important of the board of director they have to do to make decision is to choose the right manager, which is called the CEO of the company to run a company, okay, by expecting that the CEO will gonna make decision, okay, that maximize the shareholder value. You see, I can use the shareholder value instead of profit because profit doesn't mean anything, okay? But what we are interested in too is about the value of the shareholders. Okay, so the shareholders, okay, they invest in the corporation, they appoint, okay, their representatives, we could call the director, and the director choose a manager to run a company on behalf of the shareholder, and then the shareholder or board of director will monitor the manager to ensure that they're gonna make a good decision. Good decision means that the decision that adds value to the firm, to the corporation, and also to the shareholders. Everything is clear. So in our course, that we want to do is try to look at the right hand side of the balance sheet to see what are the theoretical aspects of the modern financial theory that related to the financial structure and the strategy of the firm when they make decision. The first part is devoted to the analysis of risk and return in financial markets. Okay, so basically we're going to try to understand the fundamental theories that explain why what should be the expected return that investors who are going to invest in a corporation, for example, buying a common share, what do they expect when they choose to invest in Amazon compared to Tesla, compared to Vinamilk, compared to Bank of America, whatever. Okay, so we're going to introduce you the optimal portfolio choice and capital asset pricing model, or the CAPM, which is a kind of fundamental that we apply a lot in estimating the cost of capital for corporation. Okay, that is kind of first part that we're going to focus on, probably on the right hand side of the equity part, by looking at the common stocks in a different way, because you have already studied how to do the common stock valuation using the Gordon-Chapro model and other things. So now we're gonna develop a little bit about risk and return relationship that allow us to go to one of the very famous, the equilibrium model of capital asset pricing, which is called the CAPM. And this CAPM would allow us to estimate caught-up equity capital. The second part addresses how a firm should raise funds it needs to undertake an investment in the firm resulting capital structure. So you have a choice on the right-hand side, the proportion of funding or the capital that you borrow from someone, and which is called the debt. And then you have a proportion where you raise capital from investor, from equity holder, we call equity. Some company, they have more debt, some company, they have lower debt. And when we're going to try to understand why, first of all, why some company they have more debt than other, why some company they have lower debt, what are the theory that explain the capital structure theories? Okay, so that is a kind of second part that we are essentially need to understand. We start by understanding the capital structure in the perfect capital market, Martin Miller proposition, and then we start to introduce some market frictions when the market is imperfect, how that capital structure choices, okay, may change. Okay, after you introduce some market friction, such as taxes, such as asymmetric information, such as the distress cost, and so on and so forth. And then we end up the courses by introducing you the corporate payout policy and some of the long-term financing. So this is how we're gonna organize our talk. Okay, we use the same corporate finance Burke Damaso kind of reference book, and then even you don't have book, I think my PowerPoint and the problem set that we're gonna have together should be good enough. So you have seen any questions so far? Is it okay? You understand my English? Too fast? Too slow? Or it's perfect? Perfect. So far, so good. Très bien, monsieur. Okay. So you also speak French. Perfect. All right. So before I start the course, okay, I would like to ask you how a corporation, how manager should make a good investment decision. For example, the capital budgeting decision, the project, how you going to define what is a good project or what is not a good project? You don't care about how you're going to finance it, isn't it? Right? When you do the making of investment decision. So if you have a project to invest for $1 million, you are the CFO of the company. Are you going to invest this project, this new project that costs you 1 million US dollar? You can invest or not invest. Why? You can invest only if the project creates value. When they create value, how we gonna know whether the project creates value? Based on the return and the risk. Okay, how can you define return and the risk? When the rate of return is bigger than cost of capital, what does it mean, rate of return? If I have a project that generate me the 10% return, okay? Is a good project 10%? 10% is good or not good? If you don't know, you say it depends, right? 10% cannot say anything, okay? So what we should know is about whether or not these 10% that is probably generated by the return, okay? The way we calculate the return on the project, we call the project's IRR. All right. If the project IRR, somebody know what is the project? What is the IRR? What is the IRR? What is the IRR of the project? Is the project's internal rate of return. I precise. It is the project's internal rate of return. Is the internal rate of return that generated, or the return generated, okay, by the project that make the NPV equal to 0. It's a kind of break even of value creation. That makes sense? Now, once you know the project IRR, you compare with the project's cost of capital. Okay, everything I'm evaluating the projects. Okay, so I compare the project's internal rate of return, and then I compare project's cost of capital, which is called an R. I compare with the IRR with the IRR of the projects. I compare the project's IRR if it's bigger than the project's R. I gonna have what we call the project NPV bigger than 0, meaning that the project is a good or bad project when the NPV is bigger than 0, is greater than 0. Is a good project. Okay, try to avoid profitable one. Try to use what we call the value creation. For example, when the NPV is bigger than 0, meaning that the project creates value. Okay, Why this creates value? Because the project generates a return higher than the expected return that you can expect from that project with the certain level of risk. Okay, for example, if I have the project A, I have the IRR equal to 20%, and I have a project B, the IRR is equal to 10%. Which project you're going to choose? Which project you're going to choose? The project A or the project B? Which one you're going to choose? You're going to choose project A or B? Project A is IRR 20%. Project B IRR is equal to 10%. It seems project A is more profitable, isn't it? Profitable in terms of return. Project A, no. If you don't know, you say it depends. It depends on what? Because we still don't know whether what the level of risk you're going to take between the project A and the project B. Okay? What you don't know, that you don't know whether the risk of the project A is the same as the risk of the project B or not. That's right. So in our class, we're going to try to determine what is the level of risk that you're going to take and what is the expected return you're going to take. And one way that you're going to do to evaluate the risk, okay, we can imply something called the project cost of capital, which is the R, right? I'm talking about projects cost of capital. I'm not talking about firm cost of capital. I have seen some of other people talking about the WACC, the WACC. The WACC is not project cost of capital. R is the project's cost of capital. What does it mean, the project cost of capital? The project cost of capital means that with the equivalent of the project, the risk of the project, what else, what opportunity forgone you should otherwise, if you don't invest in that project and you go to the capital market and invest exactly the same risk of that project, and what return you should expect to get, to earn. That one we call the R. Whereas the WACC is a proxy of the firm's cost of capital or company cost of capital. We're gonna refine some of those understanding, later. But you can see that our discussion we're gonna be like that to enhance your understanding the fundamental of modern corporate finance, that you should learn and know how to make a good decision. Come back to the project A and B. Okay, the project A and B. Okay, this is somebody talking about the volume of the project or the size of the project. It is not the main concern. We know that right now the company has no capital budget constraint. They can invest whatever size they're gonna do. If the project A and the B, remember the project A is IRR 20%, project B IRR is 10%. If I say that the R of the project A, okay, equal to 25%, and the R of the project B is 8%, for example. Which project you can invest? Okay, remember the project B, the IRR is 10%, project A IRR 20%, and the R of the project A, which is the cost of capital of the project A, the operating cost of capital, okay, represent with the same risk of the project A investor will require 25% to compensate the risk they are taking. The project B, the required rate of return is 8%. So it seems so obvious that the project A is much riskier than the project B. So if I have the IRR of the project A, okay, when IRR is equal to 20% and the R is equal to 25%. So what's gonna happen? The NPV of this project would be negative. So therefore, the project A that looks more profitable, but it is not a good project because the project A destroy the value. Why is destroy the value is not a good thing to do? Because if you are rational, instead of investing in the project A with the risk, with the given risk, you earn 20%. With the same level of risk you can earn in the capital market at the rate of 25%, why you gonna take the 20%? You should go and get the 25% from the capital market. So therefore, if you take the project A, it means you take the project that destroys the value of the firm. If I look at the project B, where the IRR, which is what, 10%, where the R is equal to 8%. So what's going on is the NPV of the project is bigger than 0, meaning that the project B creates value. You understand the notion, even the project A is more profitable, but it's not necessarily a better project to take. So in this case, you should accept project B and then you reject project A. So far, so good? Everything is clear to you? Is this clear to you? Perfect. You see, I know that particularly when I teach you guys who work in the banks, who work in the corporation, in finance and everything, you have some good knowledge already. So my job, obviously, I introduce some of those new concept or the concept that sometimes is not new, but I would like to refine and discuss with you so that you better understand. Okay, you better understand it instead memorizing it. Okay, because understanding is more important in professional life. Okay, because you can still apply in the real world in the more complex setting. Okay. All right, so far so good. Let's go. This is a kind of revision, refresh up some of the concept you have learned in another course, and this one is a very important important concept that you have already learned. I just want to refresh up your understanding. Okay, and hopefully that little by little you would also apply some of the terminology or technical term that you use to to understand the concept. I have seen some question. In some special cases, IRR rule may disagree with the NPV rules and thus be incorrect. That's right. So therefore, the NPV usually is is better. That's why I make the sequence of the final decision on the NPV, not the IRR itself, but just only that majority part that the the investment decision using both NAPV and IRR concepts should, you know, give you the same answer in most cases, okay, except some IRR rule may not, especially when you have different size of the, or you have mutually exclusive project that you have probably learned in other courses already, okay. But I'm just talking about a general rules that you can apply in general. Okay, now let's go and oops, go to see the first. Do I have? Okay, which is do you have the reference book? I don't know whether the CFVG give you this year. Do you have a reference book? Yes, okay, good. So what we're going to do is the risk and return that you can see in the chapter 10 in your reference book. Okay, but I gonna summarize it through my PowerPoint so that you can easily understand it, you know, before or after you reading the book. But you can, you know, go and use those, you know, reference book to read more in this one. So this one, we're gonna start by talking about the risk and return, which is the chapter number 10. All right. Okay. I'd like to show you and ask you to observe instead of reading and listening me. Can you just have a look of this graph? You see the graph? You see the red one, blue one, brown, yellow, green, and violet. Okay. So the figures shows the value of $100 invested at the end of 1925, okay, in different type of financial instruments, okay, that you choose, okay. So, and we want to see up to 2005, what is the nominal value? I'm talking about nominal value of your investment of $100 invested in 1925. What the value grows to the value in 2005. Okay, for example, if you did nothing, you just keep $100 at home and let the value of $100 in 1925 grows with the CPI. Somebody know what is the CPI? Somebody know what is the CPI? What is the CPI? What did I do? The CPI, what did I do if I invest in those? What is a consumer price index? What is a consumer price index? So if you have the CPI at the period T okay, minus the CPI or the change of the CPI over the period, okay, we call it as the, what we call, this inflation rate, right? The inflation rate represents the change of the price index. For example, when you have the basket of goods, Okay, you observe the price in Vietnamese dong at the year 2000, and then you look at the same basket. You observe the price in Vietnamese dong in year 2001. Okay, after the COVID, we have seen that the CPI of that index of Vietnamese dong in 2021 seems to be higher, much higher than the CPI of the price that you can buy the same basket in year 2000. Okay, and this one we call the inflation rate. Okay, the growth rate of the CPI index or the CPI, we call inflation rate. All right, so let's go back to this. Okay, if you take the US, everything is, we're gonna set up as the US market, everything is in dollar, and then we are in the US capital market, assume. And this one show you that your $100 grows to $1,064 in year 2005. If you're not staying and keep it in your house and let the value grows with the inflation rate, you can invest in something called treasury bills in the green line. What is a treasury bills? Anyone knows? Anyone can help me to answer? What is a treasury bill? What is a T-bills? Is the issued by the government? Okay, which government? Which government? Is the Treasury Department of U.S. government. Okay, the U.S. government borrow the money from the capital market. Okay, and remember, I talked at the beginning of the class, you borrow from the capital market. The government can also borrow the money from the capital market by issuing bonds. And since the department that take care of issuing bond for the US government, which is called the Treasury Department, and therefore the bonds that issued by the Treasury Department, they have another name, which is called the T-bills. Okay, and the T-bills is very, very important in the capital market because this T-bill, we often use it as the benchmark rate. Okay, benchmark rate for the capital market when they do a pricing of financial instruments. Okay, and this benchmark rate, okay, that we talking about, okay, we often refer to, we call the risk-free rate. What is the risk-free rate? Why we consider that the T-bills consider as a risk-free rate? What does the risk-free rate mean? Does it mean the risk is zero? No. The risk is not necessarily zero, but what we call risk-free rate is the benchmark rate that we consider that this is the rate which has the lowest risk in the economy. Okay, why? The lower risk in the economy are very close to zero, being the rate of default. They are the likelihood that the issuer, which is the U.S. government, will not be able to repay to the bondholder, to pay coupon or to pay the principal to the bondholder, is close to zero. Okay, so we can use 10-year, 30-year, you can use 3-year, 3 months, 6 months. It depends what kind of valuation you're going to use. Okay, so if you use we're going to see later on, okay, when we use the CFPM, we often use the long-term bond as the risk-free rate, okay, but you can use some short-term rate for other things. Okay, so why we consider that US government, the treasury bills has almost no risk or risk-free or lower risk in the economy because the government has US government has guns. Okay, so what is guns? They have. It means if the government, they are not necessarily the physical guns, but it is the guns that the government has the right to impose. When you're a company, you sell product to get cash flows. Where the government get the money for their financing, how the government get the money? How the Vietnamese government get the money? They get it, or any company, they come from different type of taxes. Okay, if they don't enough, they have debt obligation to pay, and they don't have enough money to pay their debt obligation, the likelihood that the government will impose to increase taxes to generate more revenue to pay that obligation is very simple. Therefore, the government has very effective and powerful guns to raise capital, to get the money, to get the cash flow to pay debt obligation. So therefore, the treasury bills, they can produce easily the way to manage the cash flow for the government, the way that they're gonna be able to finance the debt obligation is very high. So meaning that the rate of default is very low. So that's why we consider that the T-bill or treasury bill is a kind of risk-free. Okay, so it means it's lowest risk in the economy. And then we're gonna try to make a kind of uh, risk of the any securities. Okay, we're gonna be price it as the for example, if you want to know uh, uh, a rate or cost of any securities, okay, you can use the RF plus what we call the risk premium. Okay, if you want to know the cost of equity capital on a common stock, okay, we can try to determine risk premium. As you can see that in finance, in modern finance, we 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 have been working a lot on finding the way we can price correctly the risk premium of the financial instruments. Okay, some of them who price it or propose the model to price the risk premium, correctly or accurately. Okay, they some of them they got the Nobel Prize. For example, the CAPM and also the Black-Scholes when they price the option, they also got the Nobel Prize. All right. Okay, let's go back to our graph again. So you know that the treasury bills, investing in treasury bill or leaving, and you can see that the value of $100 goes to $1,943, okay, in year 2005. Okay, and this one represent the yield of a return that provided from to the treasury bills holders. Okay, the yellow one represent corporate bond. This one they don't define what corporate bond they're talking about. This is a kind of average corporate bonds. And the brown one represent the world portfolio. So you invest a basket of stocks and you invest it, some of them in the US, in France, in Hong Kong, in Singapore, and so on and so forth. And this one represent the world portfolio. Your $100 goes to 98,696. When you go to the blue one, the blue represent S&P 500. What is the S&P 500? Anyone know? What is the S&P 500? What is the S&P 500? What is the S&P 500? Is top 500 company in the US, largest in terms of market cap. So is the S&P 500 is the US market index, right? So you have different type of index. Index is a kind of, it's like a, consumer price index. You have a basket of goods, okay? And then this index, okay, you have a basket of stocks. And if you have the top 500 stock in the US, some of them traded in New York Stock Exchange, some of them traded in NASDAQ market. So if you want to get the kind of overall market performance of the US, okay, S&P, which is Standard and Poor's, okay, which is a kind of rating agency company who produce, okay, make a portfolio and calculate the movement of 500 stocks with different weights, okay, that they put in. If you want to get how they compute, okay, you can easily go to the S&P 500, okay, and S&P 500. You Google, you can see how the value have been allocated or weighted allocated in that portfolio market. Okay. So if you are interested in investing in well diversified portfolios, okay, well diversified portfolio is not just only the top company with in terms of market cap. They use different type of industry, but it's a large corporation in the US. Obviously, they often take care of a very large market cap. Okay, but they are well diversified portfolio. These diversified portfolios, okay, they have different type of index. For example, you have also Dow Jones. What is the Dow Jones? Anyone know what is the Dow Jones? No? Yes? Anyone try to type? Hongyuan, Titan. Another US market index. Can you precise what the name of the US stock market that has the market index, which is called Dow Jones Industrial Index? Is the what? Anyone knows? Anyone? Another US market index is right, but it's not precise. Industrial stock index is not precise. What the name of the stock market that has the market index, which is called Dow Jones Industrial Index? So it represents the index of large stocks traded in, no, it's not NASDAQ. It is New York Stock Exchange Market Index. Okay, so New York Stock Exchange is one of the major US stock market, and the New York Stock Exchange has a market index called Dow Jones. And then you have the obviously NASDAQ, okay, composites, which is another index of stocks traded in NASDAQ market. Since some of those NASDAQ market stocks, they are also large, okay, especially high-tech firms and all those. So if you combine some of them from New York Stock Exchange, some of them from NASDAQ, you're gonna have something called S&P 500 that combine both to get the overview of the market index. What is the market index in stock exchange in Vietnam? What's the name of stock market in Vietnam? How many markets do you have? How many stock markets do you have? You have three: HOSE, HNX, and CPCOM. Okay, so which are the different stock markets? I suppose that Ho Chi Minh City Stock Exchange, you have the HOSE, HNX, it should be Hanoi Market Index, and then you have a Upcom, which is more on the high growth company index, okay, where people trade more on the high tech stocks and so on, or high growth stocks. Okay, so if you invest in the S&P 500, which is the kind of well-diversified large market cap firms or high diversified market portfolio in the US, your $100 goes to 234,705. But if you invest in the small stocks, what do we mean small stocks? What do we mean? What do we mean the small stocks? It's not a penny stock. What is a penny stock, by the way? Man Tang Dong? What is a penny stock? What is different the small? What is the difference between small stocks and penny stocks? Man Tang Dong trading for less than $5 per share, I guess, or $1 per share. Okay, those I don't know exactly. You can search it, but it's a kind of the value of the stock is small, which is different from small stock. Small stock mean the small market cap stocks. Okay, if you invest in the small market cap stocks, okay, somebody know what the difference between what is a market cap? Everybody know what's the market cap? What's the market cap? Exactly. Is the total number of shares multiplied by the price of share is represent market value of the company or market value of, if you want to be more precise, is more on market value of equity. Thank you, Teacher Dong Guyen. Okay, which is the portion that if you have the book value, which is represent the value recorded in the balance sheet. Okay, this is we call the book value. Okay, usually you take the total number of share multiplied by the book value. Okay, the value recorded in the book. That's why we call the book value. Okay, therefore, most of when you are going to look at the growth of the company, you can have a look on, for example, the market to book ratio, and this market to book ratio can show you some kind of growth opportunity that company generate. For example, in the high tech firm, usually you have a very high market book to book value. For example, if you look at Tesla, which is growing a lot, then the market value in general is it's very high compared to Johnson and Johnson, those kind of company that they market to book in those kind of industry usually is smaller than the high tech firms. All right, so if you invest in those small stocks, you can see that $100 should go to 8.2 million. You become a millionaire, just simply invest in those small stock portfolios. Okay, now after look at this graph in finance, we're gonna try to make some kind of better understanding and quantify things on the risk and return that we better understand, we better make a right decision based on your preference of risk and your expected return corresponding to that preference of risk. Okay, it seems like some investors prefer to hold treasury bills. Some investors prefer to hold S&P 500. Some investors prefer to hold small market stocks. All right. So now, if I'm gonna borrow some kind of your high school mathematics. So finance is a kind of high school mathematics for you. Okay, especially in Vietnam, you are very strong in mathematics in general, isn't it? No, you get all the mathematics Olympics gold medal every year, so you are all great. So the mathematics that we're gonna use in this course is your high school mathematics, is not even your university mathematics. Okay, for example, the first one that we can apply is a kind of common way that we measure the fluctuation of the value, okay, and calculate the something called the expected return. For example, if you have the distribution of probability of the PR, if you know what is the return will occur of each probability, you're going to be able to calculate something called the expected return, which is calculated as a weighted average of the possible return, where the weights correspond to the probability, which is in this equation. Now, you know how to calculate the expected return. This is your high school mathematics. You're going to be able to also calculate something called the variance. And what is the variance? The variance is the expected square deviation from the mean. It represents how spread out of your distribution. If your distribution spread a lot, okay, spread out a lot, so you're gonna have a bigger variance. Okay, if you take the square root of the variance, we're gonna call it as the standard deviation. You know how to calculate the standard deviation, isn't it? After you get the standard deviation, and then if you take the return of the stocks and you calculate the standard deviation of a return, okay, in those distribution of return, we're gonna have the name, we're gonna call something, we're gonna call it as the volatility of that stock. So this is the equation of the variance. You can see that the deviation from the R minus the ER, which is the expected, and then you take this, we're gonna get it's called the variance. If you take the square root of the variance, we're gonna get the we call volatility. So the volatility again is the terminology that you should know. It measures something called the total risk. Okay, so how they fluctuated. Okay, so let's go something more exciting in observing the real world in the capital market. Okay, for example, I have two stocks. One is BFI. which is the blue one. Okay. Second one is the red one. The red one is the stock of AMC. Okay. So suppose BFI stock currently traded for $100 per share. You believe that in 1 year time, there is a 25% chance that the share will be $140. That makes sense? So if $140, meaning that you're gonna have a return of what? Of 40%, right? With 25% chance. And the likely you believe that the price of the BFI stock may go to 110 with a 50% probability. And then you have also a scenario where the price may go down to $80 with a 25% chance. Assume that BFI pay no dividend. So you have the three scenario, you have a distribution of these possible returns. Okay, what we can do from this, you can easily calculate the expected return by taking 25% of minus 20% plus 50% multiplied by 0 point or 10% plus 25% of 10%. So you get the expected return of the stock of 10%. You can see that when you see the expected return, you are forward looking. Okay, you take uncertainty into consideration. This is the expected return of the stock. BFI is 10%. If I have expected return of 10%, I just simply, apply the equation or the formula of the variance. So what I'm going to do is I just simply take minus 20% minus expected return of 10% square, but multiplied by 25% plus blah, blah, blah. I get the variance of 0.045. And then I take the square root of these BFI. I'm going to get the standard deviation of 21.2%. So now I can, write the characteristic of the stock BFI, okay, in the term, which is expected return and its volatility. All right. So if I have the expected return of the BFI, which is 10%, and I have standard deviation of 21.2%. Okay. So I can write BFI stock characteristics. They're gonna have the expected return of 10%. And then I have the standard deviation of the stock of 21.2%. Okay, I can define these BFI stock in two term or two characteristics: the characteristic of expected return and the characteristics of the volatility. So far so good? So far so good? This is high school mathematics, huh? Nothing complicated. Perfect. Thank you. Now let's go back and try to have a look on the AMC stock. Okay, AMC stock, they have 45% return with the chance of 50% and minus 25% with the 50% probability. If I calculate the expected return for the AMI stocks, I gonna be able to get, wow, exactly the same, 50% multiplied by 0.45 plus 50% multiplied minus 0.25. I get also expected return of 10%. Okay, then I compute the standard deviation or volatility. I use the formula of the variance. I calculate the variance of the stock. The variance of the stock goes to 0.1225. I take the square root of 0.1225. I get the standard deviation of this stock of 35%. Everybody can see here, right? So if I use the AMC stock, I write the characteristics of the stock, which is 10%, and the volatility, I write standard deviation of the R equal to 35%. Everybody can see now the comparison of the BFI stock and AMC stocks, that we can see that from this graph. Both stock, interestingly, generate the same expected returns, isn't it? ER equal to 10% for BFI and ER equal to 10% as well for the AMC. But interestingly, the same expected return, but if you hold the BFI stock, you hold the volatility, or you bear volatility, which is the level of total risk of 21.2%. Whereas the AMC, the volatility is 35%. Which stock do you prefer if you are an investor? You have only two choices, to hold BFI stock or AMC stock. Which stock do you prefer? If you don't know, you say it depends. This one, Nguyen Quoc Trúc Tan say BFI. Obviously, you can make decision in this context that the BFI is better to invest, because with the same expected return, you bear lower risk. Okay, if you are rational investors. Okay, because this day we also call some behavioral finance that emerge this day. Okay, that some investor, they are irrational, they are not rational. Okay, for example, one of the rationality refer to that people prefer more to less. For example, if I give you $10 or $20 to choose, rational investor will choose 20 because the more prefer to less. Okay, however, they are in the capital market where people may behave differently. They will prefer 10 instead of 20. We call these investors as not irrational. Okay, we can learn that later on. I can introduce you some behavioral finance that have been recently developed. Okay, perfect. Everybody is okay now. You need a break. It seems like you're tired. I'm also tired. It's very late in Vietnam at the moment. It's in the afternoon. It's about 3:26, so which is 20 something, almost 3:30 here. So shall we have a break? Do you need a break? You want to have a break? Yes? Perfect. So we have a break of how long? What is your traditional break? 15 minutes? It's okay? Or 20 minutes? 15 minutes? Yeah. Okay. We can take 15 minutes, and then if I finish my class before 10 p.m. in Vietnamese time, I will stop so that you can have a shorter break, and then you can finish our class a little bit earlier. That makes sense? Good. Thank you. So see you in 15 minutes. All right. So I stop recording and then I continue back. See you. Bye-bye. Okay. So let's look at the example for people I forgot to record, and so we can repeat a little bit that instead of putting the explicit probability and the expected return, we can use the historical return to calculate the average return, arithmetic, geometric average, and also calculate the volatility or variance of those realized return and take square root of the variance. We're going to get the volatility of stock based on the historical return. Okay, so to illustrate with the real data of the US market, as you can see that if I take S&P 500 index, 500 index is the US market index, okay, of last stock in this portfolio. And as you can see that these stocks, if I take 1995, the S&P index is 615.93. In the end of 1996, the index goes to 740.74. And of these 500 stocks, the total dividend received in 1996 represents $16.61. If I calculate S&P 500 realized return of these 770.74 divided by 615.93 minus 1, I get 23%. Okay, so I calculate exactly the S&P 500 realized return based on capital gain and then dividend. I gonna get the total return of 23% in 1996, 33.4% in 1997, 28.6% for 1998, and so on and so forth. In year 2000, 2001, 2002, I have negative 9.1%, 11.9% 2001, 2002 minus 22.1%. Okay, as you can see, this period is known as the dot-com bubble, and that make the kind of negative return during that period. Even look at the GM realized return. Everybody know GM, right? Everybody know GM. Either everybody know GM? What is GM? What is a GM? A General Motor. Okay, I take the General Motor stocks. I can see that the 8.6 in 1996 is that stock return performance of the General Motors stock, 19.6 for 1997, and so on and so forth. You can see the, and then I have 3 months T-bill return, which is 5.1% in 1996, 5.2%, and then is 1.4% in 2004. Okay, based on these real information data receiving from the capital market, I would be able to calculate, for example, the average annual return of S&P 500 stocks from 1996 to 2004. The average annual return is about 11.4%. Okay, and this 11.4%, if I calculate the variance of this S&P 500, I can have this data, and then I calculate the variance and the standard deviation. The volatility of S&P 500 represent 20.6%. So I have another characteristics like the way I do it for BFI and AMC. Okay, I have the now is based on the real return. The average return is 11.4% and volatility of 26% for my investment of S&P 500 of last stock in the US. I do the same thing for several type of financial instrument that we have seen it in the first graph. Remember this one? Okay, I calculate the realized return, average return, and volatility of each one. As you can see, the volatility that represent the fluctuation, you can see that small stock, they can go up, down, up, down, up, down. Where you look at the treasury bill is almost smooth, okay? And the line is less fluctuated, okay? So let's calculate, okay, this kind of real financial instruments, okay, in the market. And as you can see here that the average return for small stock is 22.11%, where small stock has the volatility of 42.75%, whereas S&P 500 for a longer period from 1926 to 2004, the average return is 12.32%. So therefore, S&P 500 stock market index that generate about 11 to 12% approximately. Corporate bond is 6.52%, treasury bill is 3.87%, whereas the return, the volatility is, going from 3.18% to 42.75%. You can see here the T-bill, the risk is not zero, okay? But if the lower risk, which is called treasury bill, okay, we consider as the lower risk, okay, we're gonna be able to calculate something called the excess return. And this excess return, if I take the return volatility, okay, this is return volatility. If I look at what is the additional return excess on top of the treasury bill. So I can see that on the small stock, I get the extra return, excess return here of 18.24%. Where does the 18.24% come from? Where is the 18.24% come from? Anyone? It's come from where? Anyone? Where the 18.24% come from where? By the way, by tomorrow, do you have a calculator? Can you bring calculator with you? You can use scientific calculator or the financial calculator like this, or any type of calculator you have, because it's gonna help us to calculate during the class together. So can you tell me where the 18.24% come from? 18.24% come from where? 18.24% come from where? Come from 22.11 minus 3.87, which is 18.24. And this 18.24 represent what? It is the risk premium or average risk premium of small stocks, okay? That represent the additional excess return over the T-bill. Remember when I talking to you as the return on any security? In finance, we can price it with the RF plus the risk premium. Okay, in these small stocks, as you can see, the R of the small stocks, okay, can be written as the RF. What is the RF? RF is 3.87%. Okay, 3.87% plus the risk premium, which is 18.24%. So you're gonna get the return that generate by the small stock of 22.11%. Everybody follows? Yes? Then, if you understand what is the 8.45%, what is the S&P 500 risk premium, the average risk premium on S&P 500? S&P 500. Anyone? Do you have, if you have a calculator with you, you can calculate by yourself. So you can take 12.32 minus 3.87, which is the risk-free rate. You're gonna get 8.45%, which is what? Is the S&P 500 risk premium. It means if you're investing in the portfolio of large US stocks of S&P 500 portfolio, you can expect the risk premium to compensate extra risk you bear beyond the treasury bill investment. Okay, you're gonna get the return, extra return of 8.45%. All right, and this, if you take the corporate bond, I can have 2.65%, and treasury bill is zero, extra return. Okay, because this one we call the risk-free or benchmark rate of 3.18%. Oh no, 3.18 is the volatility. The risk-free rate is 3.87%. Sorry. All right. Wow. If interestingly, if I take different type of stocks portfolio, I can, plot the graph based on volatility and the average return. I have something that look like straight line where I have a higher risk. I gain different generate higher return in proportionally. All include, for example, mid-cap stocks. Again, when we call small or mid-cap or the firm size in the stock market, we often refer to the market value of equity or market cap. If we include all these, and you can see that, the relationship between the risk and return look interesting because you have some kind of predictable linear relationship on the large portfolios of different type, S&P 500, T-bill, corporate bond, small stock, mid-cap stock, like that. Okay. Oh, interestingly, if I take S&P 500 individual stocks, such as GM, Johnson & Johnson, Amazon, whatever, I plot the graph of volatility and the average return, what I can see that individual stocks have higher volatility as a given return than the large portfolio stocks. And then also there is no precise relationship between the volatility and average return of individual stocks. So if I take Vinamilk volatility and I plot with the return, I cannot easily find the linear relationship when I compare with other small cap stock in Vietnam, for example. Okay? So that is lead to an interesting relationship that have been working by many economists, financial economists in the 70s, 80s, trying to find out why and what explain the relationship on these individual stocks, risk and return. And they end up with some kind of understanding and find out that when you measure the risk of a security by computing or calculating the volatility or standard deviation, And the standard deviation only measure one way of the risk, which is called the total risk. However, if you dig inside the total risk, actually the total risk has two components. The first component we call idiosyncratic risk. Idiosyncratic risk is the risk that is specific to that company or that firm. Okay, and the fluctuation of the stock return due to the firm specific new this type of risk we call the firm specific risk, or we call unique risk, and or we call unsystematic risk. The nice thing about these unsystematic risk or firm specific risk is that these firm specific risks can be diversified away. That's why we call also the idiosyncratic risk as diversification, the diversifiable risk. However, you have another type of risk which is systematic and which is undiversifiable. And this one we call the market risk or systematic risk. Since you are not able to diversify these away because we call undiversifiable risk, so therefore this systematic risk is the risk that investor should get compensation to hold it. However, the idiosyncratic risk, which is diversifiable at no cost, therefore, the idiosyncratic risk, you won't get any compensation to hold diversifiable risk or idiosyncratic risk. Okay, because it is diversifiable. If I give example of which of the following risks of the stock are likely to be firm-specific diversifiable risk, and which are likely to be systematic risk, which risks will affect the risk premium that investor will demand. The first one is the risk that the founder and the CEO retire. It is idiosyncratic risk or systematic risk. Any answer in the class? The risk that the founder or the CEO retire is a firm-specific risk or diversifiable risk. Okay. Next, the risk that the oil price rise, increasing production cost. Is a systematic risk or diversifiable risk? This is it is diversifiable. The oil price rise, obviously each company may have different degree of this risk. It should be the systematic risk. Okay, the risk that the product design is faulty and the product must be recalled, and this one is the idiosyncratic risk or diversifiable risk, and the risk that the economy is slow, reducing demand for firm products. This is called systematic risk. The risks that come from the coronavirus pandemic that affect the economy, and these COVID-19 is a systematic risk or diversifiable risk? Is a systematic risk. Okay, perfect. Now, interestingly, that if I have the look at the volatility of a portfolio in different type of stocks, okay, I assume. Now, if I increase number of stocks in my portfolio, everybody understand what is a portfolio means? I hope. Yes. Do you know what is a portfolio? I use it a lot before telling what does this mean. Everybody know what is a portfolio? All right. The portfolio is a basket of different type of investment you put in your investment. Okay. So in this case, we have a basket of stocks, bond, treasury bill, and so on and so forth, right? When I'm talking about S&P portfolio, it means like you invest in S&P market index, which is now you can easily, buy the ETF or the mutual funds that invest, replicate the market index for you to invest instead of going and buy each stock to form your own portfolio. You can buy the fund that they manage to replicate the market index for you, okay, which is called the ETF. Um, all right. So let's assume to check your understanding, I have the type S. Okay, the type S represent firm have only systematic risk. If a firm or a portfolio or a stock has only systematic risk inside, the increase of number of stocks will not change the level of risk you take. Okay, it means like you cannot diversify anymore, or you don't have any diversifiable risk, so therefore the increase of number of stock will not change any risk profile you have. However, if you have the I firms, I stock or I portfolio, where it contains only idiosyncratic risk or diversifiable risk, you can see that the more you put number of stock in your portfolios, the volatility go down. If you have 10, the volatility decline from 30% to less than 10%. If you have 100 stock in those market portfolio, in your portfolio, you can see you can reduce volatility to almost, very close to zero. And the more you increase the number of stocks, okay, the lower risk you may have in your portfolio. That is only if you have, this is the example when you have only the idiosyncratic risk type of stocks. Now, which is not realistic, the typical firm, if you buy, for example, a GM stock, the GM stock, if you combine with Johnson and Johnson, with Microsoft and everything, so the number of stock you increase, okay, will reduce until you cannot diversify it anymore. You can see here the line. So the systematic risk will remain unchanged. For example, if you take 500 stock, you can see that the 500 stock, most of idiosyncratic risk of your 500 stock in your portfolio almost diversified away. So therefore we often assume that S&P 500 portfolio is a portfolio which is we call market well diversified portfolio. Okay, it means we can assume that the market well diversified portfolio as a S&P, as the S&P 500, we can consider that this portfolio is a portfolio that contain only the systematic risk or the market risk. Okay, all the idiosyncratic risks have been already diversified away. Therefore, we later on you can see that we can assume or use the S&P 500 as the proxy of the market portfolio. Market portfolio means that the portfolio that has only systematic risk. Okay, everybody know what is a proxy means? because in finance we use a lot. What the proxy means? So in any business or in finance or anything, everything is a proxy. What does a proxy mean? An authorized person or is a principal attorney relation. No, in a more technical term, is not a legal term. A proxy means, for example, if I want to know your level of English, okay, proficiency of your English, I use your TOEFL score, okay, to measure your English proficiency, okay. I use the TOEFL score as a proxy of English proficiency, okay. And if my English proficiency, I don't know how good you are, but I can compare someone who have a higher score, a lower score, and I use it as a proxy of your English proficiency. If I cannot measure something, and then I, use a variable to proxy, okay, to represent something that I don't know how to measure precisely, okay, but I can get some kind of approximate. For example, the standard deviation of return is, we call it as volatility, okay, and this volatility of a stock measured by the standard deviation is a proxy of total risk of the stock. That makes sense? Okay, so if I use, for example, I want to measure the market risk. Okay, I have a measure of total risk. I use standard deviation as a proxy of total risk. I want to use the measure of market risk. I can use example of variable that can measure the market risk. I use as a proxy of market risk because you have so different way to measure market risk or different type of risk. I can use, for example, the beta as a proxy of the market risk. Everybody understand what the proxy means? The proxy, you can use it in your professional life, easily. Okay, so that is what we call a proxy. Now, interestingly, okay, since we have diversification, and diversification can eliminate idiosyncratic risk, but diversification does not eliminate systematic risk. Because investor can eliminate idiosyncratic risk, they do not require a risk premium for taking it on. Okay, because you have no cost to combine investment of 2 stock, 3 stock, 5 stock, 10 stock, which is called diversification. And then this diversification from the graph that we can see that can eliminate the in some idiosyncratic risk. Okay, so because investor can eliminate idiosyncratic risk, so therefore they do not require a risk premium for taking it on. Because investor cannot eliminate systematic risk, they must be compensated for holding it. As a consequence, the risk premium for a stock depends on the amount of its systematic risk rather than its total risk. It means that if you want to, look at the return of a stock, the return of the stock should be depending on the systematic risk or the market risk rather than its total risk. Therefore, we can learn later on that the standard deviation of volatility is very hard to use volatility to predict return. But if you use the systematic risk proxy, such as the beta may allow you to calculate the expected return or the return to hold those kind of stocks. And that's it for the chapter 10. So any question? Important to get your question. Do you have any questions? We have already 105 minutes lessons. So any questions? You have any questions? You're tired? Are you okay? Are you happy with my class? Are you happy? Yes? Yeah, okay. Don't don't just say yes before the exam. Everything is clear? Okay, my teaching style would gonna be like this. The only thing that is still missing in the first class that I gonna continue for tomorrow is I would ask you to apply the concept that we learned together in the real world. So the real world that we're gonna start with is about the problem set, and then I will introduce you from time to time the real world with the actual, actuality of thing going on in the U.S. or international capital market and so on and so forth, so that we can discuss, we can understand better. Okay, so do you have the problem set? You have problem set with you? The problem set look like this. Let me share with you. Okay, you have the problem set with you? Yes? Okay, so you can see that the concept that we learned today, for example, the question number 1, okay? If tonight it's too late for you, okay, don't do it. So for example, tomorrow, if you have time before the class, if you want to practice the concept that we learned together, for example, question number 1, you have stock A, you have stock B, the different type of return with different probability. There's the stock A and there's also stock B. Calculate the expected return of the two stocks, calculate the standard deviation or the volatility of these two stocks, characterize the difference between the two stocks. What trade-off would you face in choosing one to hold? Question 1 is okay. You are able to do so. Can you do it when you have time tomorrow? Otherwise, I can correct it with you tomorrow, but just only for you, to motivate you to be to assess whether you understand something we learned it today or not. The problem set would allow you to check your understanding that we learned together. Okay, since you are professional already, you are not just only the young student, and try to do it whenever you have time. Okay, otherwise I can show you how to do it. Question number 2, we can learn together tomorrow in chapter 11. Okay, for this time only question 1. Can you do it as a not a homework? I hate to tell you this is a homework, just only for you to practice, for the people who want to brush up your standard deviation calculation, your high school mathematics, those kind of things. You can do question number 1, and then tomorrow before I start for the second slide, set of slide, I will correct the first problem set first, and then we continue with the next one, which is more and more exciting. Yeah. Any questions, everybody? I will be almost 30 minutes, a little bit finish earlier if you don't mind. Any question? Let's have some question before we go. No one want to know about the exam? So everybody should pass the exam. No? Will you teach us any other courses? Normally, I teach another we call international finance for corporate track students. And then also the international finance. I often use the real Harvard Business School case, and then we use a very advanced on how to estimate international cost of capital. We use a project oil field project in Venezuela, how we, address some of the risk premium, country risk premium, those kind of thing. And then we do some foreign exchange, international parity, those kind of things that is include in the international finance. And then when you are in banking track, or if you are free, you can join the group of those advanced courses. So which is the international finance that I teach the second course in the CFEG program. At ESCP, I also teach emerging markets finance, okay, that I discussed a lot of issue. My specialization is emerging market finance. For the exam, you can have a formula sheet, obviously. The formula sheet is given. I don't know what the modality that we're going to use this year, but I guess that since we are online, we are a little bit far away. Last year, the situation still allow a student to come to write the exam at the university at CFVG. So I provide some of those exam, and then you do it, directly, and then but the exam last year we also prepare for the online option, but since the pandemic allows you guys to come at that time. But let's see the situation of COVID-19, and then I can tell you more maybe before the end of the class what kind of um, type of exam we gonna give it to you. The only thing that we're gonna do is we're gonna do easy. No, not necessary. So relatively okay. So the idea of the exam is to assess your understanding, right? It's just only the formula sheet will be given. I can tell you what you need to prepare. So if you follow my classes all the time, so I can see that some of you come and go. I can see 48, 45, 50. I don't know how many you are. So if you don't really have any urgent things, please join the session. Okay, you can save your time for your exam because I try my best to deliver, to explain, to make something complicated easy. So you get a lot of advantage to be in class, to listen, to directly participate with me. Obviously, is also register. If you have some incident not be able to attend, you should look at the video and so on. But I hope you enjoy my class and you don't feel boring in taking my class. So please come to join the class live, and then you're gonna see that all that we're gonna do together over these 24 hours would be make your finance knowledge in just only, easy. The exam, I'm gonna make it easy, so let everybody pass. Obviously, I may have some more difficult question to ensure that some people get 18, some people get 16, some people get 20. If you understand, everybody can get 20. If you want 20, I give 20 to everybody. You okay? You accept it? Everybody get 20? Yes? Do you agree? All right. So I give you 20. Everybody got 20 at the beginning of the exam anyway. So, and then it's going down little by little. If you go down until 10, you pass. If you don't, what you gonna do? If you fail, you can still see me and write the resit exam. Hopefully you don't write the resit exam. If you still cannot pass your resit exam, you come to see me next year. Hopefully not for this course, but maybe more advanced courses. All right. If you don't have any more questions, I gonna close the session today. I wish you a great evening. Relax and take care. And the same time, we see you tomorrow. Yes. Thank you very much for your attention for today, and looking forward to meeting you tomorrow. Bye-bye.